Asset depreciation codes. Fixed EUL versus statistical EUL. Depreciation is the method of allocating the cost of a tangible asset over its useful life. Businesses depreciate long-term assets for both tax and accounting purposes. The former affects the balance sheet of a business or entity, and the latter affects the net income that they report. Syspro allows different depreciation types or methods to be applied to assets. Depreciation codes can be applied to all depreciation books, such as book value, tax value, and all alternate valuations. Fixed EUL depreciation. Although assets are only supposed to be used for a certain number of years, if the asset still works at the end of its estimated useful life, companies usually still make use of the asset in the case of computer equipment. Fixed EUL depreciation calculates an asset's depreciation on the asset's useful life in periods, on the assumption that the asset will no longer be in use at the end of its EUL period. The difference between this type of depreciation and other depreciation methods is that the exact number of periods to depreciate the asset can be defined, as opposed to defining the percentage per year by which the asset must be depreciated. As such, the fixed EUL depreciation method has a simple formula of the cost of the asset over the total number of periods in its useful life. Lenny's company recently set up a computer system for their distribution warehouse. The computers cost the company $15,000, and based on the advancement of technology, he estimates that the computers will be obsolete in 4 years or 48 periods' time. So the asset's purchase price divided by the asset's total EUL will give us a depreciation value of $312.50 for each period. Multiplying this by 12 will give us a yearly depreciation of $3,750. This depreciation value will remain constant throughout the asset's life. After 4 years, Lenny will replace the computer and the cycle will begin again. Statistical EUL depreciation. Unlike other depreciation methods, statistical EUL depreciation's unit of measure is not date-orientated, but rather uses units of measure like mileage in the case of vehicles or usage in the case of production machinery. This method takes into account the possibility that the asset might not produce the same output every period. The depreciation for each period is calculated as the asset's cost over the total usage for the life of the asset, multiplied by the unit usage for that period. Lenny has found that he needs a new photocopier for the office. He purchases it for $400,000 and estimates he'll have to replace it after 1 million copies. Due to the fluctuation in employees' copying needs, the amount of copies made each month will change. In the first period, after the photocopier was installed, employees at Lenny's company made 2,500 copies, so the cost, divided by the total estimated usage, multiplied by the usage for that particular period, will give a depreciation value of $1,000 for the first period. The next period will have 5,300 copies being made, so the cost divided by the total usage multiplied by the period's usage gives a depreciation of $2,120. Continuing with this formula, we can see that his annual depreciation amount for the first year will be $20,340. The remaining value for the photocopier is $379,660. If the copier continues to depreciate at about the same rate every year, it will reach a $0 value amount at the end of its 11th year of use. To recap, fixed EUL depreciation works on the assumption that the asset will no longer be in use at the end of its useful life. It uses the estimated periods rather than the percentage per year to calculate an asset's depreciation. It also has a fixed depreciation value. Statistical EUL depreciation has a unit of measure which is usage rather than date-orientated, such as mileage, hours of work, or units produced. The length of time that the asset is used depends on how often it is used rather than being set by an estimated years of usage.